Hi everybody, welcome back to our 6th unit in our course Research on Corporate Transparency. We're talking about tax transparency. So taxation is an exciting topic. Not really my key area of expertise, I have to say, but no fear. I think the topics that I want to talk about in this series of videos are so fundamental that even I have a clue about them. And then for the more complex issues, we will see Martin Jakob, and he can, he can balance everything that I say in these videos, and he will so. So, okay, perfect. So let's dive into this, and I start with a little bit of terminology, just so that we have a common understanding on what we actually understand as tax transparency. Because now in this course, up until this unit, basically, we were talking about transparency in general. So we were trying to be rather broad in our understanding, what type of information we are looking at, what type of information exchange we are looking at. But now in the last 2 units, we will pick on 2, let's say, hot topics in corporate transparency work. And the first one here is the issue of tax. So to understand what tax transparency means, basically, you can just build on the standard definition of transparency that we employ. So it's always focused on a receiver-sender information exchange. And so the focus is on the information as it's actually being received and processed by the receiver in the end, right? So this is a process that starts with generating them and distributing them, and then at some point, the receiver has to receive them and to process them. So, and it's about tax. Yeah. So not that surprising. Okay. So now when you think about this in terms of content, you instantly see that this is actually relatively broad. So for example, you could think about the transparency about certain tax rules and their application and enforcement, right? So, we know that tax rules are complex, it's very likely that not all individuals are aware of all tax rules and at any given point in time. And this is almost certain, right? And it's also relatively reasonable to assume that even sophisticated agents like firm managers are not necessarily aware of all these rules and regulations. Well, this is why tax advisors exist, right? So the transparency about this rule set is a thing, and actually is so much a thing that it even has its own term. It's called tax complexity. And so this area is something that we don't cover here in this series of videos, but it is also an exciting area to work on. Okay, so the question of how much do we actually know about the regulatory framework and how complicated is the regulatory framework. Then you can think about transparency about individual taxes, also exciting area, in particular in public finance. And you can also think about transparency about corporate taxes. And this is what we are focusing on, right? So we are interested in wherever there is sufficient information exchange about the way that corporations pay their taxes. Okay. So then there's another layer of tax transparency, which is also interesting and very much related to public finance. And that's the question where we as, let's say, citizens know what the government actually does with our dear tax money. So the question how tax authorities or the governments behind tax authorities actually use the funds that they collected via taxes. Okay, so this is also a transparency question. But as I said, here in this series of video, we will be mostly concentrating, or we will almost entirely concentrating on the issue of corporate taxation. Yeah, so because it's research on corporate transparency. Okay, wonderful. Good. So then another thing in terms of terminology, whenever we talk about taxes and tax strategy from a corporate perspective, there's always this line between what is legal and what is no longer legal, right? So, and obviously this line can blur. So there is a gray area where you're not entirely sure what you're doing is actually legal or not, or also where knowledgeable experts in the tax system can actually disagree. Yeah. So, but from a terminological standpoint, it's first of all important that we have 2 different terms to actually talk about it. And so I think in the tax literature, at least in the accounting tax literature, the distinction is that whenever we talk about tax evasion, we're actually talking about illegal activities, or in principle illegal activities. Whenever we talk about tax planning or tax avoidance, then we are talking about something that is assumed to be legal. Yeah? And again, that doesn't mean that everybody would agree it's legal. So there could be this gray area, but in principle, the key thing is that the manager or whoever decides on the strategy is actually trying to decide for something that she or he believes is legal. Okay, so this is the distinction. So tax planning, tax avoidance, and this is what we will concentrate on for most of the time during these videos. This is assumed to be legal. Okay, good, perfect. So now that we settled this, there is another thing that we would need to deal with, and this is, overwhelmingly rich in institutional detail. This is the type of tax transparency disclosures that actually exist. So here, I'm very lucky that there is this wonderful survey working paper by Müller, Stengel, and Fey, which is also in your reading for this unit, because this really helps to get a quick overview over all the reporting requirements here. And this is a figure directly from the working paper, and it helps us to structure all the tax disclosures that are actually there. So I think the most important differentiation here, and this is also a little bit, also speaks a little bit about the used terminology again, is the differentiation between private and public disclosures. So private disclosure, for me as a financial reporting person, is a little bit of an odd term, because most or large parts of the financial disclosure literature actually consider disclosure to be public by definition. So to be aimed at a wide, previously unknown range of users, right? So in this part of the literature, so in the tax disclosure literature, this is not necessarily the case. So here you can think about disclosure more as general, information transmission. So it can be private. And when it is private, it means it's not to an unknown range of users, but it's been disclosed to a selected small set of users, and the by far most important selected set of users would be tax authorities, right? So the rules that tax authorities and supranational coordination like the OECD develop, these rules are aimed to provide the tax authorities with information from the firms, and this is being labeled as private tax disclosure in this literature. So it's a little bit of an odd term, but anyhow, so since we have it, so the whole right arm that you see here is basically private tax disclosure, and by far the most important bit here, I think at least for the empirical stuff, is this private country by country reporting, which is part of the OECD BEPS program. And so this is, I think, also in the literature, one of the most prominent disclosures that is currently being studied. But there are additional pieces of information that are also interesting. And the idea is here so that the tax authorities, based on this information, can better understand the behavior of corporations and also identify, let's say, potential loopholes in the regulation that need to be addressed via rulemaking. Okay. Then also there might be private disclosure to other parties. The biggest example, also from the working paper, is simply investors demanding tax filing data from firms. This is relatively common in bank firm relationships in the private market. So when you are a small firm within, for example, the German setting, and you ask for a bank loan, then it's reasonably likely that the bank actually asks for your tax filings for two reasons: A, to see and to assess your financial situation; B, to get an idea whether you are a diligent and compliant manager. Okay, perfect. So then the other arm is the public disclosure, and here by far the most important bit, obviously, is the firm level reporting. And here, the general purpose financial reporting, this is the financial statements, as we have been talking about prior to this course. And this is where you have these additional informations contained in the tax footnote that explain the deferred taxes and the actual taxes, and gives a wealth of information that researchers can use to assess the effective tax rate. This is not without problems. So if you would be engaging in this kind of research, I think there is a lot of methodological housekeeping to do here. And personally, I have my reservations about how informative these tax measures based on publicly observable financial statements can actually be. But anyhow, we have to live as a field. We have to live with what we have, right? And there isn't that much information on actual tax reported numbers. in particular, in most countries of the world, there are some exemptions in the Nordic countries, for example, where tax payments actually being disclosed more often. But in general, we have to live with public data. So there's additional information sometimes contained in the MD&A, and maybe also in the work that analysts provide or in conference calls. Yeah, so there might be additional information. So then there is a relatively new thing, and that's public country-by-country reporting. Yeah. So public country-by-country reporting is similar to the country-by-country reporting that is issued to the tax authorities. But the EU has developed a plan so that actually European firms have to disclose their revenues and their profitability by country to increase public scrutiny on the business activities of international corporations and public interest entities. Okay, so these type of reports are also being studied. You will see this also in the unit when I talk about the effects of tax transparency. Yeah, but then there's also additional disclosures. And one thing that I personally find very interesting is, the disclosures that are being provided not by the firm themselves, but by, for example, tax authorities or other regulators, because they can also disclose, for example, the taxes that have been paid by large corporations. And there are some interesting aspects here, some interesting strategies that tax authorities can follow in order to use these type of disclosures to actually, let's say, motivate firms to become less tax aggressive. Okay, so you see that all this is rich and has a lot of institutional detail to it. So when you want to do work in this area, I think it's very important that you embrace this institutional richness. So doing tax research requires you to become a tax expert. And while this is challenging, at least for me it would be, I think it's also really worth the effort. Yeah, so because this is what characterizes good work in accounting and tax research, that it actually cares about the institutional details that sometimes are a little bit glossed over in the public finance literature and economics. So I think in total, all what you see here is not just interesting from a descriptive standpoint and fascinating to study, it's also very promising in terms of research, because all this variation here, of course, provides quasi-experimental settings that one can exploit to actually understand economic associations of interest. Okay, perfect. So this is the first video. I wanted to give you a pointer on how to familiarize yourself with the institutional setting. By all means, please read the Müller et al. Chapters that were allocated to this unit, so that you get an idea about what's going on. On the slide deck, you find the literature towards the end, right? But here in this case, it's only the Müller et al. Paper, and this is also in good English. So perfect. Enjoy, have fun with the reading, and then after maybe you looked into this, you can continue with the next video when we talk about the incentives for tax disclosures. Cheers, bye.